Last 2.5 years, the world has witnessed two major shocks, the COVID-19 pandemic and the conflict in Ukraine. These shocks have produced profound impact on the global economy. As if that was not enough, now we are in the midst of a third major shock, a storm arising from aggressive monetary policy actions and even more aggressive communication, especially from advanced country central banks. The necessity of such actions is driven by their domestic considerations, but in a highly integrated global financial system, they inevitably cause negative externalities through spillovers. The recent rate hikes and forward guidance about further big rate hikes have caused tightening of financial conditions, extreme volatility and risk aversion. All segments of the financial market, including equity, bond and currency markets, are in turmoil across countries. There is nervousness in financial markets with potential consequences for the real economy and financial stability. The global economy is indeed in the eye of a new storm. The Indian basket crude oil price was around 104 barrel in the first half of this year, 22-23, and this is the actual number which has been realized. Taking into account these factors, the inflation projection is retained at 6.7% for the current year, with second quarter at 7.1%, third quarter at 6.5%, and fourth quarter at 5.8%, with risks evenly balanced. The US dollar has strengthened rapidly to a two-decade high. Several advanced and emerging market currencies are facing sharp depreciation pressures. Emerging market economies, that is EMEs in particular, are confronted with challenges of slowing global growth, elevated food and energy prices, spillovers from advanced economy policy normalization, debt distress and sharp currency depreciations. The movement of the Indian rupee has, however, been orderly compared to most other countries. The Indian rupee has depreciated by 7.4% against the US dollar during the same period, that is from 1st April of this year to the date which I just mentioned, that is up to 28th September. So while the US dollar has appreciated by 14.5%, the Indian rupee has depreciated in a very orderly manner by 7.4%. And consequently, it is evident that the Indian rupee has fared much better than several reserve currencies as well as many emerging market and Asian peers. First, the rupee is a freely floating currency and its exchange rate is market determined. Second, the Reserve Bank does not have any fixed exchange rate in mind. The Reserve Bank intervenes in the market to curb excess volatility and anchor expectations. The overarching focus is on maintaining macroeconomic stability and market confidence. Our actions have helped in encouraging investor confidence as reflected in the return of capital flows since July. Over the medium term, the primacy of price stability embedded in our flexible inflation targeting framework provides the anchor for exchange rate stability.